Hello everyone, I'm Miles. Today we're going to learn through problem solving and dive into one of accounting's hidden superpowers, journal entries and T accounts. They may seem both unique and tedious, but they're indispensable. It's these tools that form the reliable and auditable foundation of finance and banking. Let's look at a simple and practical example. On January 1st, ABC Company started operations and did four things: issued $60,000 in stock, borrowed $70,000 from the bank, bought a $120,000 truck, and prepaid $6,000 in rent. The question is, how do we translate these business activities into the accounting books? The answer is, first, make precise journal entries, then post those entries into T accounts. Accounting entries have their own unique golden rule, and there's a deep logic behind it, but the fastest way to learn is to memorize the rules first. Debits are used for increases in assets and expenses, and for decreases in liabilities, equity, and revenue. Credits are used for increases in liabilities, equity, and revenue, and for decreases in assets and expenses. In every T account, debit is on the left and credit is on the right. Every transaction affects at least two accounts, and debits and credits must always balance. Let's map it out step by step. Issuing stock, cash is debited $60,000, and common stock, equity, is credited $60,000. Bank loan, cash is debited $70,000. Notes payable, liability is credited $70,000. Purchasing a truck, fixed assets are debited $120,000, and cash is credited $120,000. Prepaid rent, asset is debited $6,000, and cash is credited $6,000. Next, let's post the journal entries to T accounts, with debits on the left side and credits on the right side. For example, in the first journal entry, the debit side of the cash T account increases by $60,000, and the credit side of the common stock T account increases by $60,000. This way, both accounts are affected at the same time, and the total debits and credits, $60,000 and $60,000, match perfectly. In the second journal entry, the debit side of the cash account increases by $70,000, and the credit side of the notes payable account increases by $70,000. In the third journal entry, the debit side of the fixed assets, PPE, account increases by $120,000, and the credit side of the cash account increases by $120,000. When you post each journal entry to the T accounts, the flow of value becomes clear, the inflow and outflow of funds, and the company's assets, liabilities, and equity claims. The balances of these T accounts are precisely the raw materials for the three major financial statements: the balance sheet, the income statement, and the cash flow statement, and they also make the ledger clear and traceable. Ultimately, accounting has never been just about memorizing rules. It's about telling the story of value. Every debit and credit is a sentence, journal entries form paragraphs, T accounts create chapters, and the financial statements are the complete book. So next time you do the bookkeeping, remember, every mechanical entry carries the flow of value within it.